It's very difficult, of course, to know when stocks hit a bottom. This massive decline has set off an intense debate, with some saying it is time to buy, while others are arguing it is too early. Joining us now is Manish Deshpande. He is head of equity strategy at Barclays, and CNBC contributor Michael Farr from Farr Miller in Washington, live joining us from Florida tonight. Gentlemen, welcome, and Steve, welcome to you again as well. Manish, let me begin by asking the kids question. Daddy, are we there yet? Are we at the bottom?
No, we don't think we are at the bottom completely yet. I think because this sell-off or this turmoil that we're seeing actually is quite different than what we have seen over the past 4 or 5 years. All of the other sell-offs that we have seen have been actually policy-driven, policy mistakes or some actions that have been taken, take Brexit, fears of the Fed tightening too quickly and so forth. This one is a truly exogenous shock. And we think policy will help, but cannot completely solve all the problems. So to your point, one of the commentators just made, it is certainly true that Fed cutting would help financial assets to some extent, but it's not going to really help in the real economy.
Michael, as we look at today's losses in the Dow, with something like 357 points, but it took a 640-point rally in the last 15 minutes to blunt the loss and hold it at 357. Do you read anything into that 640-point rally, i.e. that might be a signal that a turn is forming in the market?
No, Tyler, I don't. I'm sorry to be so blunt, but this feels like it is one of these things that's going to take a long while to develop. We are still seeing new information, right? Ernst & Young, or E&Y, I guess they are called now, has canceled their intercompany travel, and they've sent out advisories that their employees are supposed to stay away from crowds, even restaurants and bars where more than 10 or 12 people are gathered. So folks are still getting a message that we should start to cocoon, we should start to prepare. None of these things are good for the economy. What I saw today was some kind of a reflexive bounce up after the Federal Reserve told markets what markets have been used to hearing for the past few years, that we'll be there for you. But as Steve said, Pat Harker, president of the Philadelphia Fed, said a couple of weeks ago, I don't think we should cut rates. It's not going to do anything to solve a supply chain problem in Asia. So what good will it do? It makes the markets feel better. It doesn't change what's going on economically through this supply chain and how consumers in the U.S. are feeling about it.
To that question, Steve, as interest rates on the 10-year bond or note goes down to 1.11% at the low today, what would a cut in interest rates do? It's not going to stop the virus.
I think a way to think about this, first of all, is the market being in free fall. The market being in free fall, it's like creating its own storm. It creates its own economic outcomes. You could have a decline in the wealth effect. You could have all sorts. Its own weather system is a good way to think about it. Stanching that decline would be a big part of what.
And that's what an interest rate cut could do,
among other things. It could also, if there is some borrowing, lending, or consumption at the margin, that would be helped. But Federal Reserve interest rate cuts never do and are never intended to completely offset the downturn or the decline or the impulse that's the shock to the system.
Manish, what would tell you that the market was putting in what professionals call the bottom? What would the signals be?
Some of the signals that you should see is that new hedges start to be put on. So you're right that the put volumes have increased quite a lot. But based on what our flows have been on the desk, it appears to be most people are simply readjusting their hedges. Very little new hedges are being actually put on. So it doesn't really feel like a full capitulation, although the price action looks bad. From an option perspective, it doesn't feel like people are really screaming to put on new hedges.
Michael, finish your thought there, Manish. I'm sorry.
So that would be certainly one thing.
Okay.
The other thing I would say is that you need to see some news flow which is positive. So from a pure news flow perspective, you're going to start to see new cases, sort of that completely accelerating. And until that sort of slows down, I don't see a a reason to buy right now.
The new case count is decelerating in China, but obviously accelerating in places like South Korea and other places. And we have a new case here in the United States. Michael, final question to you. My notes tell me that you say we expect to have some clarity to be able to confidently make buys next week. Not a process of calling a bottom, but based on companies having solid growth prospects. What kinds of companies are you talking about here? You can either name individual names or you can give me their characteristics.
Right. As I think we talked about earlier this week, Tyler, during these periods, you have to have an investment discipline. You have to tell yourself that if these companies come down, companies I like where because the fundamentals are good, come down 10 or 15%, I'm going to do some buying. That sort of discipline helps you avoid the emotional traps that will ruin you every time. So if you have money that hasn't been put to work, I think that names like Pepsi or Procter & Gamble, very defensive kind of names, solid balance sheets, decent dividends, you can begin to take some of those positions. I don't think there's any rush. Everybody, you know, when you go through something this painful, Tyler, everybody wants it just to be over with. Everybody wants to look and say, geez, that was it. We made the V bottom. Let's buy it now. You can't right now do that. You don't want to catch this falling knife, and you need to be patient.